We continue to see deflation in the West as a key driver of financial markets. Governments in development economies are unable to engage in additional government spending. That results in a much lower growth trajectory going forward in the US and the Eurozone. To top it off, equity exposure has been adjusted to favour stocks that benefit from a weaker rand. So quite complex. Joining us in studio to explain how we should go about allocating our assets in these times is Tony Bell, who's Portfolio Manager at Vunani Fund Managers. Looking at a macro level before we go into our asset allocation in South Africa, Tony, deposit flows in Europe, that's something that interests you, where the money's moving from to where?
Yes. Dave, what we've picked up in the recent couple of quarters is investors are becoming increasingly concerned with their deposits in peripheral banks.
What's a peripheral bank?
Anyone in Greece, anyone in Spain, anyone in Italy.
Peripheral is a swear word.
Yeah. The Southern European region has seen massive deposit flight from their banks through to the Bundesbank. And that's creating a very interesting dynamic that is moving ahead of the pace of political reform in Europe. If you're moving money from the peripheral zone banks through to the Bundesbank, and that money is being re-lent back to those peripheral countries, essentially Germany is taking on the liabilities of some of the debts of the peripheral countries. So to the extent that the markets have now moved ahead of the politicians and the political initiatives, we see a very interesting thing, or we see something that needs to be watched very closely, and that is deposits, because when financial markets get scared is when you start to see deposit flows, the traditional old style bank run.
Of course, it also suggests that what happens in politics, often in other fields too, is that the politicians take aim and they fire, but the target's already over there.
Yes.
And then they move, but the target has already moved, Wayne.
Yeah, well, that's quite normal. I mean, politicians will only really act when forced to. Either they're going to lose an election or something's going to collapse and they're forced to do something. I mean, this is a phenomenal worldwide. Politicians prefer not to do anything most of the time, but eventually they're pushed to do something. But capital money votes with its feet.
It's like a river,
no mistake about that. Yeah, you know, and a lot of people are betting that the euro will collapse. I don't think it is, but a lot of people are betting that the euro is will collapse. So it's quite simple. Put your money with the Germans, and when the new German mark comes back again, that currency will go up and you'll make your profits from a capital gain, because you're doing it at zero interest rate. There is no money being paid on this thing. And of course, that's why you've seen a lot of money's gone to the US as well. That's why you've seen a weak euro in comparison to the dollar.
So, Tony, what is the meaning of this? Have the authorities realized this? Are you a prophet here that you know, people are not listening? What's the practical effect?
I learned a long time ago in auditing that you follow the money. And so what we're seeing in the asset allocation implications is, with the money moving through into the Bundesbank, we're seeing a very, very high premium being paid for so-called risk-free assets. US interest rates, US 10-year treasuries are down at virtual record lows. That's nothing new. German bunds are down at record lows. But what interests us more is what happens next. How does the ECB respond, and how do the politicians respond? And the market, to a large extent, is starting to force their hand. So from an asset allocation perspective, we see the transmission mechanism through the currencies, the dollar staying stronger for longer. We're a little bit light on commodities at the moment. We've reduced over the last quarter our exposure to a lot of the commodities, sold out of Kumba completely, reduced Anglos and Billiton. And what we're looking for from a stock selection perspective is we've gone into companies that have got good balance sheets, high free cash flow. Now, if you think of this sort of central theme of risk-free assets and safe assets have a premium, companies with strong balance sheets and good cash flows at a bond level and at an equity level are a better potential investment than a bank. And what companies like SA Breweries, for example, are busy doing is reducing their cost of their equity by issuing bonds at very low interest rates, retiring some of the bonds that they have already issued at much higher interest rates, and they're able to sustain their profit margin by doing that. And that, in this environment, for us, is a very big investment theme going forward. companies that are able to maintain pricing power, companies that have control over their product and the price of that product, but more importantly, companies with strong free cash flow that can improve their profitability by reducing their cost of debt.
Now, Tony, that's been the case for 3 years, 4 years now.
Sure.
In other words, sell Anglers by SAB or by ShopRite.
Sure.
You know, it used to be by Richmond, but in the last month or two, Richmond's taken a bit of a duck, but it's coming back a bit now. This will change at some stage.
It will change.
We will have a cycle, you know, sure as day follows night, there will be a cycle at some stage. So now you sit with SAB at 28 PE and Anglers at 7.
Yes.
The difference between the two has never been this big since they have both been listed.
Correct.
Do you just stay with it? In other words, a trend's your friend and stay with it? Or do you hang your hat on a valuation? Or a valuation difference, more correctly?
The situation's fully recognized. That is the big call to be made. What we're looking for from a macro perspective is we think things will get a little worse before they get better. We think, as Wayne has pointed out, politicians will then be forced to act. We are sitting with a very interesting dynamic where Dr. Bernanke at the Fed has pumped a lot of money into the US economy, into the US banking system, and Mario Draghi as well as at the ECB. So the banks, the central banks, have already taken over the role that governments should normally have been fulfilling by increasing their spending at this time to help the economy recover. That's not happening. So what we see and what we're looking for, and the trigger point we'd be looking for to answer Wayne's question, is if we do see some sort of concerted action where things get bad to the point where governments have to respond, and you get QE2 from the ECB and QE3 from the Fed, that's the time to move into commodities. Because I think at that point in time, you'll start to see more of a pro-growth bias. What we see at the moment is that the Eurozone is still behind the curve. They haven't recognized that growth is the problem. They're still focusing on beating one another up with austerity measures.
So the answer to your question about commodities is yes, but there's going to be a time.
It's a question of timing.
How will we know? Will someone wave a flag? What will that flag be?
That flag for us is more QE.
More quantitative easing?
Because things are going to get worse before they get better.
Well, the way they're talking about Greece and Spain now, that can't be too far off.
I think Spain is well known. I think the one to watch, which is not yet on people's radar screen, is France. There's a new sheriff in town, and the sheriff intends to spend. And France's debt to GDP ratio is not looking that healthy. So if the rating agencies start to move in and start to question the cost of all the social spending and the current increased government spending, AAA might be under threat. And unlike the US, the French government does not have control of the printing press.
I was going to say the difference here with the UK and the US and other countries as opposed to the Eurozone, there are things that are out of their control which other normal countries don't have.
The market will just vote at its feet long before the credit of the rating agencies with this. I mean, sniff this. The market. So watch the French bonds. And of course, as with any politician, it's sometimes very different as to what people say and what they do. Because the market will just not allow the latitude to go crazy, because interest rates will just
It's like our policymakers, you come into office and then you're hemmed in on all sides by things.
You must rather watch what politicians do far more than what they say. Far more so.
Let's talk about China. You expect a soft landing for China. That's the bit of a debate at the moment. What is a soft landing defined as, and what is a hard landing defined as, Tony?
It's a really interesting question. I think a lot of people look at China in these very broad terms, and they seem to become quite fixated with the GDP number. Is it 7.5? Is it 7.6? To us, the number really doesn't make a big difference. What we want to look at is the underlying detail. How are consumers coping? Are wages increasing? The job market in China is quite tight. There are real wages going through. We don't have the levels of unemployment that we see in Spain or other peripheral Eurozone countries. So the general picture that we see if we look through the headline GDP number is of a relatively healthy consumer. The savings rates are high. Government has the capacity to build more empty cities.
They've got surpluses.
They have surpluses. And I think China is very cognizant of the fact that their own process of urbanization needs to progress and not stall. And for that reason, government will be supportive of measures to increase internal consumption.
Well, there was a little stat last week which wasn't widely reported, 17% increase in internal lending in China.
Yeah.
Correct.
Now look, the Chinese government is trying to pump more credit in, but what Tony said is entirely correct. The real future is not building cities and factories and Escoms in China. The real future, or the future economic trend, is consumerism in China, i.e. the consumer. So don't be surprised if in, I don't know, 20 years' time, China's a net importer, not a net exporter. They're going to do exactly the same as what any country has done down this path, which, by the way, is not terribly good news in the longer term for our resource shares, because you'll need more flat screen TVs rather than just coal. But the biggest single factor is food.
Yeah.
This is the biggest single
Well, hence
factor.
Chinese companies and government buying up land in Africa.
Absolutely.
Yeah, this is the last bread.
Yes.
This is the last bread basket. It's got the biggest arable land that's not yet cultivated in the world by far is in Africa. So maybe our future is in fact agriculture and not mining. But these are long trends.
Wouldn't it be ironic that our economy has always been agriculture based, followed by mining, and then we might go, well, the mining stuff has to run out eventually.
Yeah.
We go back to agriculture. The British did it, regarded as colonial. The Chinese are doing it. It seems to be more politically correct for them to do it. But Tony, fascinating stuff. But how would all this affect your asset allocation in South Africa? And,
in South Africa,
the South African market.
We're quite comfortable with our equity exposure at around sort of normal levels. We don't see any reason to be overly defensive at this stage. Where we are taking the defensive qualities of the portfolio through stock selection, focusing on those companies that can generate the high free cash flows we've been talking about and are able to increase the value add that they accrue through to shareholders. I take Wayne's point fully that there will come a switch quite shortly, and we're very aware of that. How we're positioning it in the portfolios is through the mining houses. We've got exposure to Sasol, Anglos and Billiton. For my sins, I do have some exposure to Exxaro, which is hurting a bit at the moment. But aside from that, we've counterbalanced that with stocks like BAT, Rainet, and we believe in stocks like AVI, which have very good business models, good underpins. I would throw Woolworths and Truworths into the mix, and MTN. So we've got a really nice, high-quality portfolio of industrial stocks. And you know what? You were chatting earlier on about the Reserve Bank cut. Chlelo said we need all the help we can get. We thought the South African economy was doing pretty well. You know? Most retailers were reporting between 11 and 15% turnover growth. Profits have been on the increase. Bank credit is increasing quite nicely at 16%. Unsecured lending is strong. So we see the South African economy in good space, and we see those companies able to maintain their earnings growth profile going forward.
That's a cheering note, an unusual note in these times to hear a cheering note, but a cool, sober look at the markets from Tony Bell. Thanks, Tony. He is Portfolio Manager at Vunani Fund Managers.